Hi everyone, we are now going to look at Chapter 6, which is still on inventories and some special things we do with it, for lack of a better word right now. So let's take a look at what we're going to be seeing in this chapter related to inventories. So we're going to identify the items that make up merchandise inventory. We already talked about this a little bit in Chapter 5, but now we're going to reiterate it and make sure we understand when we include something in inventory. Identify the costs of merchandise inventory. We're going to analyze the effects of inventory methods on both financial and tax reporting. We're going to look at the effects of inventory errors, because we're humans, we make errors, on current and future financial statements. We're not going to do analytical 3. Procedural, we're going to look at computing inventory using specific identification, FIFO, LIFO, and weighted average costs. So we'll be talking about what the heck those things are and why do we need them. And P2, the lower of cost or market amount of inventory. Okay, we're not going to do P3 or P4, those are appendix. So let's get started. Let's take a look at what makes up merchandise inventory. Remember, merchandise inventory includes all goods that a company owns, and that's the key. They have to own them to be included in inventory, and they hold them for sale, regardless of where the inventory is located. So it doesn't matter where it's at. What matters is, does the company own it? So sometimes we have to give special items attention, like goods that are in transit, that are on like the truck or the airplane on their way to us. The question is, do we own them? And if we do, are they in inventory? Are they in inventory and they shouldn't be? Goods on consignment and goods damaged or obsolete. So let's take a look. Remember our shipping credential, I guess you can say, FOB shipping point, FOB destination. So FOB shipping point tells us that the buyer owns these goods while they're being shipped. So if we have any inventory items in transit that are FOB shipping point on December 31st or the end of our accounting year, they should be included in our inventory. If they are not, FOB destination, these are goods are not included in our inventory until they arrive. So the seller owns them still while they're being delivered. So we have to check to see, are any of the goods in inventory really still owned by the seller? And take them out if they are. So we have to pay attention to items that are in shipment at the end of our accounting year and make sure those that we own are included in the inventory and those that we don't own are not. Goods on consignment. So you see all these little consignment shops around, and just to get an understanding of what a consignment shop is, it's just a physical location for different owners of goods to have their goods on display, and someone who owns the actual shop sells them. So all the consignor does, or I'm sorry, the consignee, the person who owns the consignment shop and maybe rents the shop itself, the consignee doesn't own any of the stuff in their shop. The consignor does, the person who gives the consignee goods. So the consignee never has inventory. The merchandise that the consignor gives to the consignee to sell for them is still the consignor's inventory. The consignee never has any inventory. So let's give you an example. You see a lot of like clothing stores. I used to do this too with my son when I bought better quality clothes for him. Kids grow out of stuff really quick. So I would take his clothing. I couldn't open up my own little clothing shop and start selling my son's clothes. First of all, there weren't enough. And second of all, I just didn't have the time. So what I would do is take his clothes as the consignor to a little clothing boutique, a consignment shop. And other people like me would be consignors as well and bring their stuff. So now we have a whole bunch of clothing, different sizes for maybe little boys and little girls in one place. And that's what the consignee does. The consignee gets the place and sells the goods for the owner. So I would go in and say to the owner of the shop, the consignee, here's my son's clothes. See what you could sell them for. And they would sell them, and maybe they would keep half of it as their profit, and then they would give me the other half. The whole time I owned those clothes still. So the consignee never bought anything off of me. They just allowed me to use their space, and other people like me to use their space. So there was one central location. Companies will do that with other companies. So if a consignee puts inventory of their own at another company, they still own that inventory. The consignor still owns that inventory. The consignee doesn't own it. They're just putting the consignor's inventory on display for them. I hope that made sense. Damaged or obsolete goods are not reported in inventory because you can't sell them. So damaged or obsolete goods which can be sold are included in inventory at what you can sell them minus normal selling costs to sell them. So if you have to pay anything extra to sell them, you subtract that. And it's that value that they're listed in inventory at, not what you paid for them. And a loss is recorded when damage or obsolescence occurs in inventory. So we just want to bring your attention that sometimes there's unique things happening in our business, and we just don't say, oh, inventory is everything that I got a bill for. No, not necessarily. If something's damaged or obsolete, we may need to reduce what we carry that inventory at, not its cost, maybe what we could sell it for minus some selling expenses. If we have inventory out in consignment, that's part of our inventory still. We can't say, can't see it, isn't ours anymore. No, that is still ours. And the same with the shipping. All right, so what's an inventory? What are the costs of merchandise inventory is our learning objective 2. And it's everything to get the inventory ready to sell. And we saw that in chapter 5. So it's all expenditures necessary to bring an item to a sellable condition and location. So inventory cost always is the cost of the inventory itself, the actual cell phone you're selling at your shop. How much did it cost you, merchandiser? Minus any kind of purchase discount you were able to take. And then add other costs. Shipping, if it was shipped FOB, shipping point. If you had to store it or pay for any storage, any insurance while it was being shipped, or any special import duties, those being taxes on items you're importing or bringing into the country from other countries. These are all debited to the inventory account because that's the rule. The inventory costs are everything to get it ready to sell and bring it to a location. Now, we didn't talk about internal controls yet, and that's actually our next chapter. But internal controls, just to bring them up and so you can understand a little bit about them. In our world, especially in business, there's quite a bit of fraud that occurs, stealing of assets, or just not only fraud, but also misplacing of assets, recording and making errors in accounting related to assets. So to try to alleviate those kind of circumstances, companies create procedures. And internal controls is a lot more than procedures, but that's how you can view them right now. So in a procedure, that always takes place even when you use a perpetual inventory system, and I mentioned this in chapter 5, is that you always physically count your inventory items at least once a year. And you come up with a dollar amount value on those items. And that should just about equal the balance in your inventory asset account. If it doesn't, you have to adjust the account, an adjusting journal entry, to agree with your physical count, just like we do with supplies. Okay? You've got to make sure the asset value in your records reflects the physical asset you have. Some more procedures are companies will use pre-numbered inventory tickets so that only merchandise with these numbers that are pre-numbered will be tagged and all numbers are accounted for. Okay. People who count inventory should have no type of inventory responsibility. So people from other departments who have nothing to do with inventory should be the ones counting it. You don't want the people who are responsible for the inventory counting the inventory. That's a fruitless exercise. Counters confirm the existence of the inventory, the amount and condition of it. Sometimes a second count is taken by a different counter. And manager confirms all items are counted only once. So it's very important that we take a physical count, and these kind of procedures are in place when we're doing the count. Now, that's how we determine what's included in inventory. And that was a great little slide about inventory internal control. But what's this chapter really all about? Well, usually what I do to illustrate this when I'm in front of a classroom, and it's hard to do when I'm on a video, and you can't even see me. But what I'll do is hold up a marker, one marker, and I'll say, this marker cost, and you could do this yourself. You could use it with paper. This piece of paper cost 25 cents. We bought it the beginning of the month, and we sell it for 50 cents. Okay, put that piece of paper down. That's now on your shelf to sell. The next piece of paper, so you're going to pick up another piece of paper, a different one, and say, okay, now this piece of paper we bought in the middle of the month, and it cost 30 cents. We're still going to charge the customer 50 cents. Okay. And then I pick up a third piece of paper and I say this piece of paper cost 35 cents. So our supplier has been increasing the cost of our paper, but we're still going to charge our customer 50 cents. So the selling price doesn't change, 50 cents, and all three pieces of paper are the same type of paper. So here's the deal. Whether it's the paper we bought the first of the month, the middle of the month, or the end of the month, they will all have the same exact barcode on them. So when they are scanned at the register says, oh, you sold a piece of paper charging the customer 50 cents. Okay? So I hope you're following me on this. So now what I do is I go, okay, remember that piece of paper? The first one cost 25 cents. The second one costs 30 cents, and the third one costs 35 cents. And I picked all three pieces of paper up, I put them together, I turn my back to the classroom, and then I just select one piece of paper. And I go, when I sell this one piece of paper, how much did it cost? And I'll get varying answers. I'll get, well, it could have cost 25 cents. I go, yeah, you're right. Could have cost 35. Yeah, you're right. Could have cost 30. Yeah, you're right. Because we don't know which piece of paper we just sold. We just know we sold a piece of paper and we charged our customer 50 cents. We have an idea because we only had three pieces, and one cost 25, one cost 30, and one cost 35. Now at this point somebody will say, well, why don't we remove the 25-cent one because that was the first one in inventory. That's a great way of looking at it. And there's actually, if you see number 2 there, first in, first out. So that is one way we could decide how much the paper cost that we just sold. Somebody else will say, well, what about, why don't we take out the 35-cent charge? You know, last in, first out. The last item we bought was just sold. That's another way of removing inventory, last in, first out. And somebody else will say, why don't we just average the three costs together and say that that piece of paper was the average cost? That's number 4. Now, number 1 says, you know which piece of paper you sold. Sometimes you're in industries like high valued inventory where you don't have a lot, like maybe high-end vehicles or jewelry. So, you know, you're not Walmart selling paper towels constantly. You might sell a high-end, very expensive piece of jewelry twice a year. Well, you could track that cost rather easily. But in the United States, we're not like that yet. Your paper towels all have the same identification code on them. Each one doesn't have its own unique ID as of yet. Some countries have that, but we don't have it in the United States. So when we sell a piece of paper, a roll of paper towels, we know what we sold and we know how much we charge the customer. But we don't know how much that specific roll of paper towels actually did cost us. So we're allowed to pick one of 4 ways to determine that cost. And if you go, well, that's not right, well, that's the way it is. You pick one way and you always use it to remove your inventory. Now there's a graph there, a little pie chart that shows what most companies use. So you can see 48% of companies, I think this is in the United States, use FIFO, first in, first out. So they assume the first items they bought are the first ones they sold, and that's how they remove their inventory when they sell it. 28% of companies use LIFO, which, by the way, we're the only country in the world who uses LIFO, last in, first out. It was created by Congress for tax purposes. The FASB adopted it. Okay? So that assumption says, well, no, we'll remove inventory assuming the last item we bought was the first one we sold. And then weighted average, about 20% of companies. I can tell you Starbucks uses weighted average. So a United States company that uses it. Walmart European uses FIFO. Walmart domestic, LIFO. And I know this because I could go to their website and see it on their financial statement. So maybe when we're in our problem portion, I'll show you that so you can see. You could go to any public company's financial statements and see which method they use. And then we have the other, which is probably more specific identification. You know which item you sold, so you know how much that piece of paper cost. So let's take a look at these methods. Okay, so that's a busy slide. This is an overview. So as I said, the assumption is with first in, first out. The first item you purchase in inventory is the first item you sell. So when you're trying to figure out how much do I debit cost of goods sold and credit inventory for when I sell something, you make that assumption. The first ones in are the first ones out. So back in chapter 5, your author told you how much everything cost. But in the real world, you got to figure that out. And you use one of these methods to do that. Now, take a look. Under FIFO, for this sale, looks like the sale price was $100. Cost of goods sold, where we store the cost of the goods that were sold, was $45 using FIFO. First in, first out. The second method, last in, first out, says no. Assume the last item you bought is the first one you sold. Oh, okay. So I sold something charging the customer $100. The last item I bought that I sold here for the $100 cost me $70. So that's the amount I'm going to debit cost of goods sold for and credit inventory. Take a look. When you subtract that now, look at that gross profit, $30. So FIFO, your gross profit is $55. LIFO, it's 30. And then average cost says, oh, we sold it for 100. Okay, so we have 3 items. They cost us a total of 180 bucks. So their average cost per each one is $60. So take it out at the $60. Debit cost of goods sold on the day of that sale, credit inventory for the $60. So that's all you're figuring out here. When you sell inventory, how much do you debit cost of goods sold and credit inventory? In this case, it would be 60 bucks. So now your gross profit is in between. It's a 40. Okay, so remember that. So you're going to have all different gross profits. Take a look also. Your inventory balances are going to be different under the 3 methods. However, make sure you remember, no matter what method you use, you're still going to pay overall the same amount of money for the inventory. Looking across, whether it's a purple, an orange, or a green, they all cost the same amount. You don't call your supplier up and say, hey, I use FIFO. What kind of deal do you have for me? No, they don't care how you remove your inventory. Cost isn't based on what method you use, but what method you use will impact how much your gross profit is. So there's back to that slide. Beginning inventory plus purchases tells us everything we could have sold. Some of it we will sell. That will end up in cost of goods sold. Some of it will still be here. That will be an ending inventory. So let's take a look at how we actually do these computations. Remember, how you actually sell inventory, physical flow, does not have to exactly match how you remove it. And this used to freak me out when I was learning this. I'm like, how do you know everybody's buying the oldest thing? You don't. You pretend. Okay? So the physical flow is how people buy stuff. The way we figure out how much to debit cost of goods sold and credit inventory is an assumption. They're 2 different things. So there's no inventory police there going, hey, your customers buy last in, first out. They take the newest stuff and buy it first. You can't use FIFO. Yes, you can. So they don't have to match. And that's hard for people to overcome because we just assume that's how it's being sold. Not necessarily. All right. Okay. So here is information about mountain bike inventory. And this is in your book too. They start the beginning of August with 10 units of inventory. Let's say it's bikes, 10 bikes. And these bikes cost them $91 each. Remember, this is what they cost the company, not what they're charging for the bikes. On August 3rd, they purchased 15 more bikes. Now they cost them $106. So they added 15 more bikes. So now they have a total of 25 bikes. And that's how much they cost. On August 14th, they sell 20 bikes. They charge their customer, so the selling price of those bikes, $130. That isn't how much we debit cost of goods sold and credit inventory. That is how much we will debit cash and credit sales revenue for, what we charge the customer. So you're going to take that 20 times 130, $2,600. But when we sell those 20 bikes, we just removed 20, so there's only 5 left. Then we buy on August 17th 20 more bikes. Now they cost us $115 each. Then on August 28th, we buy 10 more bikes. The prices increased to $119 each. So if you're going, wow, those went up a lot of money. Yeah, well, this is just a theory example. I mean, in the real world, maybe it doesn't go up that significantly. But now on August 30th, when we sell 23 bikes, now we're selling them, charging our customer $150 each. So that's our sales revenue. So nowhere here does it tell us which of the bikes we sold. We don't know. They tell us how many bikes there are in total. When we sell them, we subtract from the total, but we don't know which of these bikes, August 1st purchases, the August 3rd, the August 7th, who knows? So let's see how we figure this out. Using that example, let's say the total cost of the 55 units available for sale are $59.90. Okay, so what is this saying? This is saying that this company knows exactly which bikes, when they sold them, exactly how much they cost. They specifically identified them. So they will remove them at their actual cost. Okay, and that's one way of doing the removal of inventory. But most companies aren't able to remove the inventory at what it actually costs them for that particular item being sold. So they use an assumption, a costing assumption, to remove their inventory. And all assumption, if you want to look at it as we're pretending, okay? So first in, first out, FIFO is the acronym, basically says the oldest inventory is sold first. So the oldest costs, because old inventory will have lower costs than newer inventory, the old costs transfers to cost of goods sold as the inventory is sold. The more recent inventory will still be here in ending inventory. So using the example we just saw with the bikes, let's take a look and see how this would work for that example. August 1st, we started the beginning of the month with 10 bikes that cost $91 each. And this, what you see in front of you, we call a perpetual inventory record. One more time, perpetual for the inventory method we use, inventory record. So this is just a record of the detail of the purchase and sale of these bikes using first in, first out to remove them. So we have three columns: goods purchased. So whenever we buy more inventory, we're going to list the information in detail about that. Cost of goods sold. This is the area we use to figure out what was the cost of the bikes we sold. We know how much we charge the customer, but how much do those cost us? If we don't know exactly which ones we sold, how much they cost. And then a balance of our inventory after each transaction. So we start the month off with our beginning balance. 10 bikes, they cost $91 each. On August 3rd, we bought 15 more bikes that cost $106. Now remember, it's the company buying these, we're not the customer. They cost a total of $1,590. So what do we have in inventory after this purchase? Well, we have the 10 bikes we started the beginning of the month with that cost $91 each, and now we have 15 more that cost $106 each. Okay, that's everything we could have sold related to our bikes. So on the 14th, remember we sold 20 bikes. I think we charged our customer $130 each. Well, that's sales revenue. Remember, when we sell inventory, we have two journal entries. We still need to debit cost of goods sold and credit inventory. Here comes the magic of FIFO. How much did those bikes, those 20 bikes we sold, cost? Well, under FIFO, we assume the oldest inventory items are sold first. So we look to the oldest, 10 at $91. So 10 of the bikes we sold cost $91 each. The other 10 that we sold cost $106. Multiply those out and add them together. So the amount you would be debiting cost of goods sold and crediting inventory for, $1,970. That's how FIFO works. What's left? 5 of the bikes that cost $106. So we use this record to determine the dollar amount we will put in our journal entry whenever we sell a bike or bikes. Here's the August 17th purchase. We purchased 20 more. They cost $115 each. So we'll add them to our existing inventory balance. First, we had 5 that cost $106. One second. Sorry, just my dog again. Okay, we have 5 that cost $106, and now we bought 20 more that cost $115. So now we have 2 distinct layers of inventory. And if you're like, why are we layering these? Because we need to keep separate costs separate from oldest to newest. Then on the 28th, we buy 10 more that cost $119 for a total cost of $11.90. Now we have 5 that cost $106. So we still have the 5 from the last purchase. We still have the 20 that cost $115, and now we added 10 more that cost $119. So if you multiply those out and add them together, you'll get your total inventory. But it's important we keep details from oldest to newest. So then when we sell 23 bikes, I think we charged our customer $150. So we're able to compute the sales revenue. But how much do we debit cost of goods sold and credit inventory for? Under FIFO, we say, how many bikes did we sell? 23. Okay. What were the oldest inventory? 5 at 106. Okay, so 5 of the bikes we sold cost 106. The remaining 18 are from the purchase of the 20 at 115. So 18 of those bikes have now been sold. So we're removing the costs related to those items. Total of $2,600. What is left after this sale? 2 bikes that cost $115 and 10 that cost $119 from that purchase on August 28th. So that is FIFO, removing the inventory as you sell it from oldest to newest. At the end of the month, the total balance that will be in cost of goods sold, because you'll do journal entries and post them to their T accounts, will be $4,560, the $1,970 plus the $2,600. The ending inventory balance in your T account for inventory will be $1,420, because all of these items have journal entries. We did the purchase side back in Chapter 5. We recorded the sales revenue back in Chapter 5. And we recorded the amount of cost of goods sold in Chapter 5. It's just that now we're showing you how to get the dollar amount using FIFO. Another method you have to choose from, so you don't have to use FIFO. That's just if the company does use it, that's how they'll have to remove the costs. Another method is LIFO, last in, first out. And under this assumption, we pretend the newest items are sold first. So the most recent items that were purchased, those costs are removed first. So what ends up in ending inventory? Really old costs. I remember when I was learning this going, those things must be really dusty. You know, like the things you think about. But they're not, because that's probably not how they're being sold. We're just pretending they're being sold that way, and it's okay. How we remove inventory in our accounting system does not have to mirror how it actually is sold. So here, using those same items, here's how our inventory would have been removed under LIFO. So we start with our beginning balance of our 10 bikes at $91 each. Same perpetual inventory record. August 3rd. We bought 15 more bikes. These bikes now cost us $106, so we'll add them and layer our inventory. We now have 10 bikes that cost $91 and 15 that cost $106. On the 14th, though, when we sell 20 bikes, how do we remove our inventory? Newest to oldest. So now we're going to go the reverse of our inventory. We're going to go up instead of down on our inventory balance. So what were the newest items? The 15 bikes that cost $106. Okay, those are going to be removed now. The remaining 5 bikes we sold cost $91 under this assumption. So our cost of goods sold LIFO for this first sale would be $2,045. What's left in inventory? 5 of the bikes that cost $91 each. You see that really old cost stays in inventory. On the 17th, when we buy more inventory, we'll add the 20 more bikes. They cost $115 each, and we'll add that to our existing inventory. So we have 5 that cost $91 and 20 that cost $115, layering our inventory again. And again, the numbers out to the right are just the total of those two added together. On the 28th, we buy 10 more bikes. These cost $119, and the total cost is there. After this purchase, what do we have in inventory? 5 bikes that cost $91, 20 that cost $115 because they were here before the purchase, and we just added 10 more at $119. August 30th, we sell 23 bikes. We charged our customer $150 a bike. Great. But how much do we debit cost of goods sold and credit inventory for? Under LIFO, we say, what was the newest purchase? These 10 that cost $119. The assumption is under this method, they're gone. We just sold them. The other 13 bikes are from the 20 that we purchased that cost $115. So we'll remove 13 of those 20 bikes that cost $115. So we've accounted for 23 bikes being sold using LIFO. So the cost of goods sold for this sale would be $26.85. What's left in inventory? 7 of the bikes that cost $115. There were 20. We sold 13. The 10 that cost $119 are gone, and the 5 that cost $91 are still here, according to this method. So, total cost of goods sold under last in, first out, $2,045 plus the $26.85 is $47.30, higher than our first in, first out. And that's why this method was created. But look at the inventory, lower than the FIFO method. The inventory balance is $1,260. These are both correct. FIFO is a correct way, LIFO is a correct way. Some people go, why would you pick this method? We'll talk about it. The final method is average cost. Okay, so what we will be doing is determining the average cost of the units. And okay, we're just going to go to the next slide a second. All right, we are going to use what's called weighted average. On August 14th, when 20 bikes are sold, to determine the cost of the units sold, we first need to compute the weighted average cost per unit of all the inventory items. So what does this mean? Well, we don't go $91 plus 106 divided by 2. No, that's not how you find average cost. What you do is you take the total cost of everything you own before the sale. You can see there on August 3rd, the total cost of all of the bikes was $2,500, 10 at $91 each and 15 at $106 each. Okay, now divided by the total number of bikes you own before the sale, 25. So the average cost per bike is $100. So when we sell those 20 bikes, we remove them at their average cost of $100. So cost of goods sold would be $2,000. What's left? 5 of the bikes at $100 each. So now the new cost, average cost, is $100. Let's keep going. After that sale, we buy more bikes, don't we, on the 17th? Every time we buy more bikes, we must update our average cost per bike. So before this purchase, there were 5 bikes that had an average cost of $100 each. But now we just added 20 more bikes that cost $115 each, or a total of $2,300. So what we do is we say, okay, what's the total cost of all the bikes we own as of August 17th? $2,800. 500 that were in inventory plus 2,300 from this new purchase. How many bikes are there in total? And it's just a coincidence that there's 25 bikes because they bought 20 more. So $2,800 total cost of all the inventory divided by the total number of bikes, 25. The new average cost per bike is $112. So if we sold any bikes at this point, they would be removed at $112 each. But we don't sell more bikes, we buy more bikes. So now we have to figure out the new average cost per bike. Before this purchase, we had 25 bikes that cost $112 each. We bought 10 more bikes that cost $119. So the total cost of all the bikes, $39.90. The 25 times 12, or $2,800, plus the $11.90, $39.90. Divide that by the new total number of bikes. Well, we had 25 before the purchase. We just added 10 more. So there's 35 bikes in total. Divide the number of bikes into the total cost of all those bikes. The new average cost per bike is $114. So every time you purchase more inventory, you must update that average inventory. That's why we call it weighted average. So when we sell the bikes on August 30th, we know how much we charge our customer. Well, it was like $150. But how much do we remove the bikes at? The last average cost per bike that we figured out on August 28th, the $114. So we sold 23 bikes. 23 times $114 will give us a cost of goods sold under the weighted average cost method of $26.22. After this sale, there were 35 bikes. We sold 23. There's 12 bikes, have an average cost of $114 each. So the total balance in cost of goods sold under the weighted average method would be the $2,000 from the August 14th sale plus the $26.22 from the August 30th sale, $46.22. And the balance of inventory will be the 12 bikes at $114 or $13.68. Again, different than we got under FIFO and LIFO because it's a different way of removing inventory. And there it is one last time, showing you all the computations again. So a little more work with that weighted average. All right. So what method do we pick? There's 4. Probably the best one is specific identification because now you are matching the sales revenue with the actual cost of that bike or that item you sold. But as I said, most companies are dealing in more of mass sales of products that have the same identification code. So which one do you use? Well, let's take a look at the effects. First in, first out. The good news about that, the good effect on financial statements is that your ending inventory, so your inventory balance that will appear on your balance sheet, is pretty current. Last in, first out, the positive thing is that your expense amount is current. Remember, last in, first out, you're removing current costs. So your expense is current costs. Weighted average is an average, right? It's in between. It smooths out price changes. So let's take a look at this. Here was Trekking Company. Now when they used let's just focus on that gross profit line. I'm not worried about all the other stuff, okay? We see in blue the cost of goods sold, and we see there's a specific identification column, a FIFO, a LIFO, and a weighted average. And this is our multiple step income statement. So sales minus cost of goods sold, that expense where we keep track of the cost of the goods that have been sold under each of the methods are being tracked for that example. So specific identification is the one that gives us perfect information. But what if we couldn't use specific identification? Well, or we choose not to. FIFO. The cost of goods sold under FIFO is the lowest of the other three methods. But remember, that's an expense. When you subtract it from sales, it will have the highest gross profit under the other three methods. So, most companies like to use a FIFO because it gives them the highest net income of the methods. Take a look across the bottom, right? Even with specific identification. So, choosing a method, if you want the highest income, you may choose FIFO. Take a look at LIFO. LIFO is the opposite. LIFO results in the lowest gross profit. And that makes sense because what are you expensing under LIFO? The newest cost of the inventory. You're removing that first. So your gross profit will be lowest. If your goal is to pay the least amount of income taxes, you'll use LIFO. There's and as I said, Congress created this method. I think it was back in the 1960s, early 70s, and companies started adopting it. And the FASB said, geez, since companies are using this for tax purposes, we should probably make it an acceptable method for financial statement. But there's a rule. If you use it for tax purposes, you have to use it for financial statement purposes. So some companies shy away from it because of that reason. They want their financial statements, what they give to their shareholders and their owners, to be at the highest amount they could possibly be. So they're going to pick a method that will allow for that to happen. And weighted average costs, you notice the gross profit is in between the other two methods. So you don't have the highest cost of goods sold, you don't have the lowest, you're in between. And the same with your inventory balance. So my point here is that companies will pick a method based on their own financial objective. What do they want to achieve? And based on that, they will pick the method. The Internal Revenue Service requires when LIFO is used for tax, it must also be used for financial reporting. That's what I just said. Before we go into the next area, it was just in my head now. I forget what I wanted to say. Oh, I'll think of it. Sorry about that. Oh well, it'll come back to me, I'm sure. The next objective is something called the lower of cost. Oh, I know what I wanted to say. So let me say this before I forget. Chapter 1, we talked about the conceptual framework, and there were two principles, and they were basically together: comparability and consistency. And basically, consistency said when you pick a method of accounting, you must use it consistently or from year to year to year. So when this applies to FIFO, LIFO, average cost. When you pick an inventory removal method, you must stick to it. You can't just go, oh, I'm feeling FIFO-ish this year and change. No. Okay, there are ways of changing, but it's very expensive and takes a lot of time. You just don't start using the new method. Okay, so this is where a consistency principle comes into play. Also, the disclosure principle was talked a little bit about in chapter 1. And disclosure principle says we need to give people information so they can make good decisions. Companies will tell decision makers which inventory method they use. They're required to. Okay, so that comes into the disclosure area. So take a look back at that. Learning objective 2. Here we go. P2. Computing lower of cost or market amount of inventory. What is this, right? Now, we have a principle called the cost principle, right? The cost principle says record everything at what you paid for it and leave it alone. Unless there's a rule that says you should report it at a different amount. And here's one of the rules. What this says is that your inventory amount must be reported at its current replacement cost or what you actually paid for it. So market value doesn't mean how much you're selling it for. Market value is what it would cost you to replace it. When do you determine this? At the balance sheet date. That's when you're required to really invoke this rule, when you're about to do a financial statement. And what you're asking yourself is any of the inventory I currently have in my inventory, could I pay less for it today? And if the answer is yes, you shouldn't report it at what you paid for it, but what you would be paying for it if you had to replace it. And that is the conservatism principle. Report assets at their lowest, liabilities at their highest. Now this can be applied, this rule. You could look at each inventory item you own and go, how much did I pay for it? And if I had to buy it today on December 31st, how much would I have to pay for it? The lower of those two amounts is what you're going to report. Now the good news here, guys, is that usually prices increase over time, costs increase, okay? They don't decrease. But you may have inventory items that are becoming obsolete. That maybe when you bought the item, it was a hot item, but a newer item came out and now the cost to replace that for you is less. That's what we're really focused on here. Another way we could determine is we could add up all the cost for a category of asset, a category of inventory. We sell coffee cups and coffee. Let's add up the cost of all of our coffee cups. Let's add up how much all the coffee cups would cost to be replaced and compare those two amounts. We would do the same with coffee. Or we could just look at all of our inventory in one total. Here's the cost of all of our inventories. Here's how much our entire inventory would cost to replace today. And report the lower amount of the two. So they give you some options there. So take a look. A motorsports retailer has the following items in inventory. Okay, I don't have my glasses, but they have a Roadster, 20 of them. They cost $8,500. If they had to go out and replace them on December 31st, they would have to pay $7,000. So the total cost of the items, 20 times $8,500, are $170,000. The cost to replace them the day they're doing their balance sheet, 20 times $7,000, or $140,000. So if we apply the lower of cost or market to each of these individually, which one should we report the inventory at? The 140, not what we paid for it, because the replacement cost is lower. We do the same thing with the Sprint. 10 of them, they cost $5,000, so we have them in inventory at $50,000. If we had to replace them today, they would cost $6,000. So that's the norm. They usually go up, or $60,000. So how much should they be in the inventory account at? $50,000. So if we take a look at our total cost of inventory, so total cost of inventory is what currently is the debit balance in our inventory account. So if you think about your inventory T account in the general ledger, and even if you draw a T, put $220,000 in it. That's the current debit balance because that's what you paid for your inventory. What should the balance be? $190, because the replacement cost is lower. So what we do is we debit cost of goods sold for the $30,000 and credit inventory. It's obsolete. That's how we get rid of that value. And we report the inventory at the lower of what it cost us or it costs to replace it. The final area is taking a look at the effect of inventory errors on current and future financial statements. So I know this thing used to freak me out when I was learning it, but if we take our time and think about this, if ending inventory is understated, so we recorded too little, so we wrote it down too much in that prior journal entry, we would have too much in cost of goods sold. That means you would have expensed too much, overstated it. If you expense it too much, what happens to net income? It's lower than it should be, or understated. Okay, so they have some numbers there. 2016, ending inventory is 16,000. Okay, let's say that 16,000, you can see how it flows through, was too low. It is understated. I'm sorry, it's too high. No, it's too low. It's understated. Okay, well, that's going to affect our cost of goods sold and our net income in year one. And then it's also going to affect year two. So that's what they're showing you, that errors in inventory will affect cost of goods sold and net income. And depending on the type of error in ending inventory, that will have a different impact. So if it's overstated, you reported too much in inventory. Year one, you're going to understate inventory, or a cost of goods sold, I'm sorry, and you're going to overstate net income. And then the opposite will occur in year two. So they will eventually smooth out. But if somebody's just relying on year one stuff and it's wrong, that could have a major impact on you. So we want to be careful of inventory errors. That's how it affects the income statement. What about the balance sheet? If your ending inventory is too low, your assets are too low, and your equity will be too low. We don't want that if we're going for a bank loan, right? And we don't want this to happen if we're going for a bank loan. We report too much in inventory, then we're going to be reporting too much in assets and too much in equity. Okay, so we're showing you what happens if there is an error. That's why it's important that there isn't an error, and if there is, we correct it. Okay, so that is how we handle the removal of inventory and reporting of inventory on our balance sheet at the end of the year. Don't forget about those items in the beginning where we talked about which items should be included in our inventory balance. Okay, so if you have any kind of questions, please post them to the discussion board.